Neighbourly Pharmacy. And this is a company that we've had several questions on from clients in the past. And they just put out their Q1 fiscal 2024 results. So I thought this would be a good time for us to do a little review of the business and figure out if it's something that needs to be put on our monitor list or even something that investors could purchase. So let's get into this. Neighbourly Pharmacy Inc., symbol NBLY on the TSX. It trades at $17. It's a $755 million market cap company. So what they do is they own a network of community pharmacies. That network is currently 291 locations right now across Canada. This is up from 170 locations in 2017. And the company just started trading actually publicly in 2021. Now, I actually think that 2017 is actually, that may have been the correct number for 2017, but I think they only had 170 a year ago as well, around the time that they went public. But over the past year here, the share price performance really hasn't been that great, hitting a year high of about $25, and then it's been a downward trend really for most of this year. But as I said, the company did just put out their Q1 fiscal 2024 financial results. They got a good pop in the share price. So let's take a look at those results and see why. Fantastic performance, at least at face value here. Revenue in the first quarter up 72%, almost 200 million. Now, 95% of that growth was driven by acquisitions, but there was 4.1% same-store sales growth as well. The prescription sales were actually about flat in terms of volume. So it looks to me like that same-store sales growth probably was more about pricing. But anyways, adjusted EBITDA increased 77% to just under $20 million. They successfully closed two previously announced acquisitions in late June, bringing the number of locations up to 291. Adjusted earnings per share, 11 cents compared to 9 cents last year. And they also put out their pro forma. So essentially what they think their run rate revenue and EBITDA is right now, post-acquisition. And that would be $882 million in revenue and $97 million in EBITDA. So looking at the 2023 results, mostly good news as well. 72% growth in revenue to $750 million. Same-store sales growth of 2.9%. Although same-store prescription growth actually declined during the year, down 1.2%. So this is what I mean about if they're selling less volume, then this must be primarily about pricing as opposed to volume. Adjusted EBITDA up 73% to just under 80 million. Adjusted EPS of 45 cents compared to 38 cents in the first quarter of 2023. So if we look at the growth strategy of this company, what it seems to be is really highly focused on acquisition. There has been some same-store sales growth, as we noted, but primarily this looks to be an acquisition, a consolidator, an industry consolidator. So they have referenced the fact that there's 6,500 independently owned pharmacies in Canada, and their main focus is to consolidate. So we've looked at consolidators in the past. It can be a risky business depending on how effective the company is at sourcing the acquisitions, paying the right price. But one example of a great consolidator is Boyd Group, one of the top recommendations of Keystones, but one of the top performers in Canada over the last 15 years, just across the market. And they were a consolidator of auto body repair and glass repair shops. So that's certainly something, we always like to repeat that model. So when we're looking at a company that has, a fragmented industry, they're in a position to make acquisitions. They're able to integrate those acquisitions accretively. That's something we pay attention to. And we want to know if that's something that they can repeat. The main risk, of course, is overpaying for the acquisitions. Taking a look at the balance sheet, because, of course, this is going to be a very important part of a growth by acquisition company's strategy, is how strong is your balance sheet. A lot of these companies are going to use debt in order to make these acquisitions, or use a lot of debt, especially if their share price is at a low valuation. So in the case of Neighbourly Pharmacy, total debt of just over 300 million. That's net debt to EBITDA of 2.9 times. Given that this is a brick and mortar business, we would expect to have some level of debt leverage. They are pushing up against the higher end of what we consider to be our target range for debt to EBITDA. I don't think that it's, necessarily an extremely over leveraged balance sheet at this point, but we would probably be looking more into the 2 to 2.5 times. And certainly if we started to get up into the 3 to 4 times, that's a lot of debt for them to handle. And then of course, valuation. So we're basing our valuation here on the company's pro forma adjusted EBITDA, which is 97 million. And then also the trailing earnings per share, which is 47 cents. So looking forward, there should be some growth to the earnings. But based on these numbers, enterprise value to EBITDA of 11 times and price to earnings or adjusted earnings of 36 times. So it's not trading a discount. In fact, relative to earnings, it's trading at a premium, which indicates to us that, a lot of that good news and expectation is baked into the stock. But of course, when they're putting out numbers like 76% revenue growth and adjusted EBITDA growth, oftentimes companies are going to pay at a premium. The question is, can they continue that? The same store sales growth is not necessarily that impressive. It's reasonable, but it's the same store sales growth itself does not justify a 36 times earnings multiple. So our take is, financially, this looks to be primarily a strong business in terms of revenue and earnings growth. And we like the potential of their consolidation strategy of pharmacies across Canada. Of course, pharmacies are, they're a staple business. So we would expect them, as long as they're making wise acquisitions in the right markets, to be buying companies that have stable cash flow. And it's a profitable company. So that's great. They have been able to, so far anyways, in their very short history, show good profitability. But the dependence on acquisitions for growth is a little bit of a red flag for us. It's not that growing by acquisitions is a bad thing. It's a more of a risky strategy, as opposed to companies that have a lot of internal growth, like just being able to invest in their own businesses for organic or non-acquisition growth. The balance sheet leverage at the high end of the target range. So, if we were looking at a company with really low leverage on the balance sheet and we were saying, they have a lot of capacity to add debt to make acquisitions, that would be better. But they already look like they're pushing up against the higher end there. There is that limited track record. They have not been public for very long. And then the premium valuation to earnings. So I think it's a very interesting business. I'm not running out to buy it right now. We're just going to continue to monitor it. It's just been around for a short period of time. Let's see a couple more quarters. Let's see if they can continue with the acquisitions. Certainly looking at the share price momentum, which has been mostly negative over the course of this year, it doesn't seem like there's a huge hurry to jump in with a sizable position.
Yeah, like on a business like this, like I wonder if they are thinking about doing a private placement or, an equity offering soon to just get some of that debt down so then they can continue, or maybe even just they raise some equity to continue to make acquisitions. Like I think I was just looking here, their last equity offering was a private placement in April of 2022, I believe. I think, just quickly looking at their news releases. So it will be interesting seeing now that their debt is high, or getting up there, to see if that's something that they will be doing. And, that private placement that they did, they issued shares at about $29 or just under $29. So, it is good that they raised up at, elevated prices, clearly, compared to where they are now. So that is a good thing. But yeah, we'll see if they continue to have to dilute.
Just to add in on the balance sheet, the debt is all variable. They are going to be a bit pressured from the heightened interest rate environment as well.
Yeah.
Another thing which I'm a bit surprised, because they are doing this heavy acquisition strategy. They do have a dividend. It's not that big. It's a 1.4% yield. But do you think they might prefer to put the cash back into either the company to their further acquisitions? Because normally that does produce if they do believe in the business, and obviously they do, normally that does produce a higher capital return over just handing it back to shareholders for the time being.
That's a good point.
No, I mean, and that's both of those are really good points. I personally think that if you're already have debt on your balance sheet, you're consolidating an industry, you need as much cash as you can get. And to me, a 1.2% yield, I mean, it's almost insignificant. It's not quite insignificant.
Mhm.
I really to consider something a real income stock for our dividend stock research, we're looking for yields of 2% or higher. And even 2% isn't really that much, right? So, 1.2%, that's fine. I think a lot of these companies, they just put out, because there's companies that have yields of less than 1%. A lot of times they'll do that just so that they can get on um, like indexes that are focused on income producers, and then also be purchasable by, say, funds that have a mandate to only invest in companies that pay dividends. So,
And I should add too that, using your shares as, basically capital, or using them as currency, that again, like, we've talked about it many times, that can be a good strategy. It is much harder, than just, growing organically. But, again, it can work. I'm not saying if they dilute, it's the end of the world. But again, they just have to make sure that
well, they're
they're,
trading at 36 times earnings, right? So
yeah,
that's, at least it's they're getting a good value
exactly.
for the shares that they, and that's kind of the give and take when you're looking at a company. I mean, as an investor purchasing shares, you want to buy it at the lowest valuation possible. But if a company is trading at a low valuation, they're not in a position then to use their shares to invest in growth, right? Because it's too expensive, right? I
Exactly.
mean, they're selling shares at a low valuation. But if like, so for example, if you're, trading at a valuation of 20 times earnings and you're buying acquisitions at a valuation of 10 times earnings, then that's a great creative investment potentially. But if you're trading at 10 times earnings and you're trying to buy something at 20 times earnings, there's no accretion there. You'll add earnings, but on a per share basis, your earnings will actually decline. And that's, that is a major red flag when we see that from a company. If some companies do just focus on growing the revenue, growing the overall EBITDA, we want to see per share growth.